thoughts on tax loss harvesting. So whenever I get these questions, I know there's a lot of new people. I like to start kind of by defining the terms so that everybody's on the same page, and then we'll go on to address the actual question itself. So what is tax loss harvesting? Tax loss harvesting is essentially where you sell off your losers. And when we're talking about losses and gains, we're talking about investments. So you sell off your losing investments in order to realize losses, and you use those to either offset gains that you may have from the current year, or you can also actually use up to $3,000 to offset ordinary income as well. And it helps to minimize your current year tax obligations. So a couple things to understand about tax loss, and I guess my opinion on it is it's smart. Why should you pay taxes if you have the ability to offset some of them and minimize them? Over the long run, especially if it's an investment that has generated a loss for you, it's going to help reduce your tax obligations, which leaves you with more income on a net basis and allows you to invest more for the future. So it's smart if it's done correctly and is done well. A couple of things you need to understand about tax loss harvesting is, one, it has to be like for like. So what do I mean by that? You have to offset long-term capital gains with long-term investment losses, or vice versa. You have to offset short-term capital gains with short-term losses. Any excess loss, so let's give an example. So say you own Twitter, right? So that deal has closed. You got bought out at $54.20 a share. If you bought at a price less than that, you potentially have generated a long-term capital gain if you owned it for more than a year. Well, let's say that you also own Facebook. Facebook is in the toilet this year. You could sell off your position in Facebook to realize losses for the current year and use those to offset your gain in Twitter. Now, let's say you had a $20,000 gain in your position in Twitter, and you sold the Facebook position you had and have a $25,000 loss. Well, the $20,000 gain in Twitter, you could offset $20,000 of that with the loss from Facebook, and you have $5,000 left over. Any of that excess loss can be applied to ordinary income in the current year up to $3,000. So you could further reduce your current ordinary income this year by $3,000 with that $5,000 that is less. And then the last piece of it is that anything that is left over, so after that you have $2,000 of losses left over, can be carried forward to a future year. So say next year you have ordinary investment gains, you can offset those as well. The next piece of it is, that's kind of a critical component of it, is something known as the wash sale rule. So it's basically meant to prevent kind of gaming this tactic. So like if I sold Facebook to realize losses in order to offset my gain in Twitter this year, then I can't then rebuy that position in Facebook for 30 days. And so you basically have to you can't buy what they call similar or like security. So I could potentially sell that position and I could go and buy Google, or I could go and buy an S&P 500 index fund, like that would be fine, but I can't buy back into Facebook. Or if I did, I potentially lose out on the ability to offset my gains with my losses. So that's kind of what you should understand about tax loss harvesting. And if that is all sounding like totally Greek and foreign to you, let's call that an advanced investment 401 topic. And don't worry about it if it's something that is confusing and doesn't make sense to you. But if it's something that you want to learn more about, it is, I would say, a more advanced investment topic. And it can be, if done well, can be quite advantageous.